Welcome back to the Deep Dive. We're the place you come to cut through the static, bypass all that noise, and really plunge straight into the economic insights that matter. Today, we are definitely embarking on a deep dive. We're looking at some absolutely critical economic data, specifically job numbers that just got a jaw-dropping overhaul.
Yeah, seriously, if you thought you had a pretty firm grip on, the real strength of the U.S. job market lately, get ready to have that perception challenged. Fundamentally, this isn't just some slight adjustment we're talking about. It feels more like a massive, almost cinematic plot twist in the whole economic story we've been following. Okay, so let's unpack this. Our mission today: go way beyond those surface-level headlines. We want to truly grasp what this recent, pretty profound revision to U.S. job growth figures actually means, what it means for you, for businesses, for the broader economic path we've all been tracking. We've pulled together a really fascinating stack of analyses here. Got stuff from top financial news outlets, leading economists, and of course, the primary source itself, the BLS.
They're all dissecting this pivotal event. It's kind of like we're piecing together a puzzle, right? But it turns out some of the first pieces we were handed were, well, let's just say they seem to be from a completely different puzzle box, and what a revelation it is. Okay, here's where it gets really interesting, maybe even a bit mind-bending. The Bureau of Labor Statistics, the BLS, they've just revised down U.S. job growth by a staggering 911,000 jobs. That's for the 12 months leading up to March 2025. You heard that right. Nearly 1 million jobs gone from the previous estimates. And look, this isn't just some small, routine statistical tweak. Analysts are actually calling this potentially the biggest revision in, 25 years. Maybe even ever. It's sort of like finding out your favorite sports team, who you thought was comfortably leading, was actually behind the whole time. Big shock.
It really is. And what's truly fascinating here, I think, beyond just that headline number, is the sheer magnitude of the adjustment and, what it immediately does to our understanding of that period. So to put it in a chart perspective, where we previously believed the economy was adding up, pretty healthy, 147,000 jobs each month, that number's now been slashed by more than half, down to just 70,000 per month. That's a huge recalibration. It basically means that over that whole 12-month period, the total number of jobs created just plummeted, went from an estimated 1.7 million down to only 847,000. So yeah, we're not talking about some robust expansion anymore. We're looking at an economy that was, frankly, barely maintaining momentum. This significantly reshapes our entire perception of the labor market's actual strength during that crucial time. It paints a picture of much, much weaker growth than almost anyone believed. It really does fundamentally rewrite the story we've all been telling ourselves about economic momentum back then.
It certainly does. It's like if we were tracking the economy like a marathon runner, this revision tells us our runner wasn't just slowing down a bit. They were barely jogging for quite a long stretch. The real insight here isn't just the number, right? It's this fundamental rewrite of the narrative we've all been working with. But, for some of our listeners, this whole idea of data revisions, it can sound a bit wonky, a bit technical maybe, but a shift of nearly 1 million jobs, that's anything but wonky. So how on earth did such a massive discrepancy even happen? What's the actual process behind these huge revisions?
Yeah, it's a great question, and it really gets to the heart of how complex collecting this kind of economic data actually is. The BLS uses this critical annual process. It's known as benchmarking. Maybe think of it this way. Those monthly employment numbers, the ones we all wait for on the first Friday of the month, they're based on a quick snapshot. It's a sample survey of employers. They're designed to be timely, right? Give us immediate insights. But they inherently come with limitations. Things like potential non-response, reporting errors, stuff like that. They're built for speed, basically. Annually, though, the BLS goes back, and they incorporate far more comprehensive, complete data. This includes really exhaustive state unemployment insurance records, the UI records. These cover pretty much the entire universe of employers in the U.S. Plus, they get much more detailed info on business births and deaths, things that aren't immediately captured in those faster monthly surveys. So this annual process, this benchmarking, it provides a much more accurate picture, almost like a census, you could say.
It effectively corrects and mitigates all those little non-response biases and reporting errors that can kind of build up from the monthly surveys over time. So it's this critical trade-off, you see. We get timely, immediate monthly data for a pulse check, but then we get this more complete, although yet delayed, annual benchmark data for the true accurate picture. It's a necessary cycle, a necessary adjustment.
Okay, I see. So it's that classic trade-off, speed versus precision. Maybe a necessary evil, you could say, but one that definitely leaves us scratching our heads about those initial numbers sometimes, especially when the swings are this big. I mean, for those of us trying to make sense of the economy in real time, these massive adjustments can be pretty jarring. And it's not like this is the first time the BLS data process has, raised some eyebrows. We've seen questions about data accuracy before. There were those presidential comments a while back, even the firing of a BLS chief. So how does this latest, frankly shocking revision stack up against those past concerns? Does it feed into those broader worries about the reliability of the initial numbers we get?
Well, it absolutely feeds into those concerns, yeah. And this raises a really important question, I think, about the fundamental integrity of our most vital economic data. How reliable is that first read? Historically, these annual benchmark revisions, they averaged around, let's see, 0.3% of total payroll. Small adjustments, usually. This latest preliminary revision, and it's still preliminary, the final comes next February, but this one, it's double that historical average, 0.6%. And what's more, the last 2 years have actually both been consistently above that historical average. So this isn't just some isolated blip. It seems to be part of a trend of larger than usual adjustments recently. Now, the key here is understanding why these revisions seem to have gotten so much larger, especially since the pandemic hit. What we've seen is that survey response rates, well, they've essentially plummeted. Some analysts use the word cratered. Fewer businesses are actually filling out and returning those initial monthly surveys that the first estimates are based on. So when you have a weaker initial data set to start with, BLS has to rely more heavily on statistical modeling to fill in the gaps. Then when the actual comprehensive data from those unemployment insurance records comes in later, it often reveals a much different picture. And that difference gets significantly magnified when the initial survey base was already weak to begin with. Does that make sense? This directly helps explain why we're seeing revisions now that are basically double the historical average. We can kind of connect this back to, say, 2009, right after the great financial crisis. That year also saw a very large revision. And that was partly due to modeling challenges, too, especially around trying to accurately capture business births and deaths during a period of really rapid economic change. So what this all highlights, and many economists are saying this now, is a critical need for potentially better funding and staffing for the BLS. Resources that would allow them to maybe improve those crucial response rates or perhaps incorporate more complete data like those UI numbers more quickly and robustly into their monthly estimates. It's a foundational issue for our economic intelligence, really.
Yeah, that paints a picture of some systemic challenges, doesn't it? Not just a one-off mistake. It's almost like everyone was looking at this sunny weather forecast, but the real data lurking beneath was showing a massive storm brewing just over the horizon. Does this make economists feel like they're constantly driving while looking in the rearview mirror? And okay, when we talk about nearly 1 million jobs that, well, weren't really there, it naturally begs the question, where exactly were these jobs supposed to be? Which parts of our economy took the biggest hit from this huge downward reevaluation?
That's exactly the feeling, I think, for many economists. And it's a crucial question, where did the jobs go missing? The critical insight here, I think, is the breadth of this weakness. This wasn't just an isolated hiccup in, say, 1 or 2 industries. No, it was a systemic softening across the very backbone of the private sector. That suggests a deeper underlying shift in hiring dynamics than we ever suspected. I mean, the private sector alone accounted for a staggering 880,000 of that total 911,000 job reduction. That's almost all of it. So when we drill down into the specifics, the revisions are really widespread and quite significant in some areas. Let's see. Trade, transportation, and utilities saw a massive downward revision. We're talking minus 226,000 jobs. That includes big cuts in retail trade, down 126,200, and wholesale trade, down 110,300. For retail, maybe that post-holiday hiring boost was overestimated, or maybe the difficulty retaining seasonal staff wasn't fully captured initially. Then there's leisure and hospitality, revised down by a substantial 176,000 jobs. This is a sector everyone expected to be roaring back, right? But it seems the growth just wasn't as strong or sustained as those initial surveys suggested. Perhaps businesses struggled to scale up or keep staff as much as projected. Professional and business services, the consultants, tech support, admin roles, that saw a reduction of 158,000 jobs. That sector often signals broader business confidence, so a large revision there is particularly concerning. Manufacturing was revised down by 95,000, suggests a less robust industrial base than we thought during that time. The information sector, often seen as a growth engine, down 67,000 jobs in the revision. Even construction was down by 29,000.
maybe reflecting a cooling housing market or project delays starting back then. Now, it is worth noting, private education and health services saw a comparatively smaller reduction, only about 35,000 jobs down, so that suggests maybe some resilience there. And government employment wasn't immune either. It was lowered by 31,000 jobs too. So as you can see, this really was a widespread softening across pretty much the whole economy, not just one or two weak spots. It affects everything from, the local shop on the corner to the big national tech giants.
Wow. Okay. So the cracks were far more widespread, far deeper than we initially perceived. This completely reshapes the landscape, especially for our central bank, the Federal Reserve. I mean, they've got a critical meeting coming up very soon. How does this bombshell revision, these million missing jobs, how does this scramble their plans for interest rates and, the broader economic outlook? So, yeah, what does this all mean for the Fed and ultimately for our pockets?
Right, this is exactly where these sort of dry statistics become acutely relevant to every household, every business. If we connect this to the bigger picture, this much weaker than expected job growth, especially looking back at late 2024 and early 2025, it really screams that interest rates might currently be too high. I mean, the economy just wasn't as strong as the Fed likely thought it was when they were making their recent policy decisions, keeping rates elevated. So this new revised data, it could significantly motivate the Federal Reserve to reconsider its stance, maybe cut interest rates, possibly even as soon as their very next meeting next week. Economists are certainly reacting strongly already. You've got Jeffrey Roach from LPL Financial, for example, openly suggesting that this deteriorating labor market picture highlights an urgent need for the Fed to ease rates. Gus Foucher over at PNC Financial Services, he echoes this, says it clearly indicates that interest rates are perhaps just too restrictive for the economic reality we now see. And the market, well, the market is always quick to adjust, isn't it? It's definitely paying attention.
The probability of a 25 basis point cut that's a quarter of a percentage point at the next meeting, it's already ticked slightly higher. Went from about 89% just before the news to around 92% now. It's a pretty clear signal the market sees the writing on the wall, or at least thinks the Fed might. Look, the overall story arc hasn't fundamentally changed from what we've been observing, right? We had a very strong labor market back in 2023, then a noticeable slowing through 2024. But these revisions, they indicate an even more significant slowing heading into 2025, with recent months perhaps adding only maybe 20,000 to 40,000 jobs per month. That's a truly anemic pace, barely keeping up with population growth. And it's not just jobs, of course. The Fed also has inflation to worry about. We're expecting August Consumer Price Index, the CPI, to show about a 0.3% increase. That's partially being driven, some say, by businesses passing higher tariff costs along to consumers. So the Fed is navigating this really complex landscape, right? Softer job growth clearly suggests rate cuts might be needed. But persistent inflation pressures, even if partly from tariffs, well, they still loom large.
It's a very delicate balancing act for them right now.
This deep dive has really peeled back a layer, hasn't it? Revealed a kind of hidden truth. The job market was significantly weaker for longer than we thought. It essentially pulls the rug out from under a lot of our previous economic assumptions. And that leads to this ripple effect, right? On how we perceive the economy's health and, crucially, how those big policy decisions might be made. Decisions that impact everything from borrowing costs to business investment. As we wrap up here, what really stands out to you about all of this?
Well, I think what's crucial to remember, despite all the challenges with collecting data in real time, and despite these sometimes, jarring revisions, is that this detailed benchmarking process, even though it's imperfect and it's delayed, it is absolutely vital. It's vital for ensuring we have an accurate economic understanding in the long run. Without it, we'd just be perpetually operating on a fundamentally flawed picture of reality. So this continuous cycle, timely but less precise data first, followed later by more accurate but delayed revisions, it forces us constantly to reassess the economy's true health. So maybe I'd leave you, the listener, with this thought to chew on. How do we, as consumers of all this economic information, how do we balance our, innate human need for immediate data, for real-time insights so we can make decisions? How do we balance that with the desire for perfect, undeniable accuracy, which often only comes much later? And what does that tension, that constant push and pull between speed and precision, what does it truly mean for how we should interpret all the economic news that comes flying our way?
Knowing that the truth, as it were, is often a moving target, something that only reveals itself fully over time. It's a complex puzzle, one that requires constant critical thinking, I think, and maybe a healthy dose of humility about what we think we know at any given moment.